Hello and welcome to Macro Pulse. The Middle East remains the dominant macro driver right now, but the market is increasingly treating this war as a contained shock rather than a systematic crisis. And global equities is trading back at their pre-war levels after falling more than 10% during March. Is the market's reaction completely justified? Well, over the last few days we've seen clear attempts by the Trump administration to de-escalate, but it has been messy and fragile. And the 2-week ceasefire has now been extended until Iran submitted a new proposal and discussions have been concluded. So the US and Iran is still talking, which matters the most. It tells that both sides do want a deal, but the key issue is who speaks for Iran. Is it the military or is it the diplomats? And how long can the Iran afford for the US blockade in the Strait of Hormuz to remain in place? Now, until a deal is actually reached, the Strait of Hormuz will remain largely closed and the flow of energy constrained. But even if the strait opens tomorrow, the reality is that energy will take time to normalize, and energy markets and supply will take a few months perhaps. First, what you need to get is the backlog of hundreds of tankers that is loaded with energy to exit the Strait of Hormuz. Then new tankers can come in and start to drain the onshore storage. And only then will new production start again. And all of this happens while infrastructure repairs continue. So it may take 2 to 3 months before energy supply normalizes. And we expect that demand will also remain elevated for a prolonged period because the market needs to rebuild their strategic reserves. So in such an environment, the oil price, we think, will remain above $80 for a few months. And that $80 mean that it's still 30% higher than what it was at the start of this year. Now, even with further escalation, the effects of the war is already showing up in economic data. We are seeing high fuel costs, high transport costs, supply chains are being disrupted and rerouted, and countries are adapting. So China and Asia, for instance, many countries in Asia, they are leaning more heavily on coal. And in the US, consumer and small business sentiment is falling and housing activity is also weakening. And if you look at forward-looking indicators like the global PMIs, they are also suggesting a slowdown in economic activity. Signs that the global economy is running less efficient because of slightly higher inflation, but also slightly weaker growth. So we expect the economic data to still soften over the coming months as a result of the oil shock. So in this environment, central banks won't be able to reduce rates because of the price pressures. In South Africa, this transmission of the high fuel price is very direct on the economy. At this stage, the petrol price looks to be rising again next month at R2.60 a litre and diesel at R8 a litre. And this will take the petrol price 20% higher versus last year's average, and diesel 75% higher versus last year's average. Diesel is the real issue because it feeds directly into transport, trucking, logistics, mining, agriculture. So it's a broad-based cost and growth shock to the local economy. The good news, however, is that the fuel crisis is that of price and not of supply, not at this stage. The Fuel Industry Association of South Africa has confirmed that their fuel sourcing, they have shifted away from the Middle East more towards the Atlantic basin, and so we are getting more supply from other sources outside of the Middle East. On growth, the IMF has already revised Africa's growth down from 1.4 to 1%, and we expect the fiscal situation in South Africa to deteriorate somewhat relative to the February budget. And on the monetary front, we've heard this week that Governor Hanyago has signaled that he is ready to increase rates perhaps as early as May, if the situation doesn't improve from current levels. Bottom line is, South Africa is facing a stagflationary impulse, higher inflation and slightly weaker growth. So cyclically, the economy will be challenged, but structurally, we believe the reform story remains in place. And maybe next year, this time, the SARB may be in a better position to start cutting rates again after dealing with the short-term impact of the supply shock. Speaking about monetary policy, yesterday we had the new incoming Fed Chair Kevin Warsh, his confirmation hearing in the US, and there were a few key takeaways that I want to discuss. First of all, on the topic of inflation, he believes that the Fed has lost some credibility, and he's there and his first priority would be to restore some of that credibility. He views the Fed's balance sheet as too big, and will push for that to shrink meaningfully. He thinks that a smaller balance sheet may actually reduce inflation pressures and therefore unlock potentially lower interest rates in the economy. He's committed to Fed independence, but he did add that the Fed needs to earn it and then maintain it. And on Fed communication, he said that less forward guidance may actually allow for more flexibility and more proactive policy setting. Finally, he was asked about the war, and he said that his view on the war and the impact on inflation is that it's a short-term supply shock, but that the Fed must remain vigilant not to fall behind the curve. Overall, we may get a more proactive and more disciplined Fed, but also potentially a less supportive Fed with less forward guidance, which ultimately may mean potentially more market volatility. Finally, the IMF produced their World Economic Outlook in April, and it's very much titled "The Global Economy in the Shadow of War." And the analysis in it shows that geopolitical risk is no longer just episodical, but it has become structural. And the number of conflicts is steadily rising. If you look at the geopolitical threat index and battle-related deaths, you see there's a steady rise over the last decade or so. So governments are shifting their priorities away from efficiency towards resilient, away from globalization towards strategic independence. And that means ultimately more defense spending, more supply chain disruptions, reshoring and reshaping of supply chains, and potentially also more fragmentation in global trade. This is not temporary. It's actually a policy reset which we are going through, with implications of stagflationary shocks, in that we get supply disruptions, which means higher inflation, but also confidence shocks, which means potentially weaker growth. And this will all complicate things for global central banks going forward, as they need to navigate these stagflationary shocks that will potentially come from time to time. In such an environment, South Africa remains very exposed to those external shocks, both from an energy perspective as well as from a trade perspective. But fortunately, South Africa is also a key commodity producer, and many commodities often benefits during such environments of conflict. That's all for this week. Thank you for watching.